I'm Dan Johnson, and I'm the managing partner of the Stamford office. And I'm going to talk about planning for the transfer of hedge fund and private equity interest. In 1987, Tom Wolfe wrote a book called, does anybody know? Bonfire of the Vanities. And in Bonfire of the Vanities, he referred to investment bankers at the time as masters of the universe. So he brings together Bonfire of the Vanities, which is an event that happened in Florence, Italy, symbolizing the battle between heaven and hell in the 15th century. And Masters of the Universe, which is a Mattel product memorializing the battle between He-Man and Skeletor. I mentioned Tom Wolfe because in 2008, he wrote in the New York Times that the new Masters of the Universe were hedge fund partners in Greenwich, Connecticut. And so this is consistent with what we see at Cummings and Lockwood. Historically, if you look at our clients, a lot of the wealthiest clients were senior executives in public companies. If you look at the new wealthiest clients now, a lot of them, many of them are hedge fund partners, private equity partners. And so that is a change in our business. And so it's as a result of that, gradual change in our business. By the way, not a wholesale change in our business. We still have a lot of corporate executives from public companies. These new clients are forcing us to get into a world that has its own terminology, has its own issues. And so we thought it's worthwhile to spend a couple minutes on it this morning. Here is the hedge fund. Here's a diagram of the common hedge fund structure. If you're an investor, your investment is going to go into the limited partnership, and that's where the investments are going to be made. That's how you're going to make your money as a limited partner. You don't really care about what the owners care about. They care a little bit about the management company. The management company is the business of the hedge fund. That's where they're collecting their 2%. That's where fees are. That's where securities compliance is happening. That's where rent is being paid. That's where salaries are being paid. But the magic of this is the general partnership interest, and that is where the carry is being paid. And as most of you probably know, the carry is a profits interest in what's happening in the limited partnership. The profits interest is usually what percentage? 20%. It can be as high as 40 or 50%. Does anybody know, this is my last question for this well-educated group, does anybody know why the carry is called the carry? So in medieval Italy, cargo carriers would carry cargo from one destination to another, and they would take a profit based on the value of the cargo, and that profit was frequently 20%. So carried interest comes from what was happening in Italy in the 16th century. Most of our focus this morning is going to be on the carry. Sometimes it's called the promote or the performance fee or the incentive fee. But before we get there, let's distinguish a little bit between hedge fund investing and private equity investing and the structures. So in a private equity fund, what you're hoping to do is invest in portfolio companies if you're a manager, and you're going to increase the value of those portfolio companies in anticipation of an eventual sale. So you can hear in that description, this is not going to be an overnight process. This is something that's going to take a couple of years. On the short side, 3 to 4 years. On the more traditional side, 8 to 10 years. And during that period of time, there's not going to be a lot of liquidity. You're getting a 2% fee as the manager based on the committed capital in the fund, and some funds will decrease that fee based on the committed capital that's actually deployed over time. But then once funds start to come in, there's a waterfall of how they're going to be distributed. And the waterfall goes like this. First, the first people who are going to be paid back are the investors in the fund. So the fund limited partnership, the people who actually put money in are going to get their money back first. That makes sense. They're going to get a hurdle, and a common hurdle is an 8% annual return based on the funds that they put in. So that limited partnership, a lot of people like me are going to call it senior equity because they're getting paid back first. And they get first priority. The junior equity is the 20% profit. So the GP interest that's getting the 20% profits is the junior equity as I'm describing the waterfall. So again, the waterfall is senior equity first, pay back the capital, pay back the 8%. After those two things have happened, then you can start to distribute your carried interest profits. In a hedge fund, largely similar. There's a 2% fee that's based on the current value of the portfolio. Hedge fund investing is obviously different. It's investments in equities, commodities, and debt. The incentive allocation is paid on an annual basis because we have liquidity here. We don't have to wait a couple of years for liquid assets to flow back out. So the liquidity of the fund is more predictable and reliable. Before I get too far into the carry, I want to talk about the management company because this is the least valuable least volatile part of the hedge fund structure. And again, this is where the activities of the fund are happening. So this is the name of the office, this is the office manager, this is salaries being paid, benefits being paid, rent being paid, utilities being paid. So, as an investor, I don't really care that much about that. As the owner, I care a little bit that the fund is well run. The management company is not making an investment in the fund itself. It's just taking care of the administration of the fund. It has a contractual relationship to do that, so it's not junior equity, it's not senior equity, it's not equity at all. It's a separate standalone structure within this entire framework. So there's no volatility. I should mention something that you should have on your radar. In the private equity world, there is frequently a fee waiver mechanism, and so what that means is that the managers will generously say, we are willing to not take our taxable income as long as you allocate that income towards our capital commitment in the limited partnership. So instead of we'll forego that income, but use it to cover our capital commitment. You can hear, as I'm describing that 2% management fee, it sounds like personal income. It is personal income. It's not assignable from an income tax perspective. And so as we go into assigning carried interests, assigning capital account interests, we're going to leave the management company alone. So how do we get to vertical slice planning? This is a planning technique, or what I'm about to describe, which is not vertical slice planning, is something that preceded most of your speakers' professional careers, but was very popular in the 80s. And the idea was you have a family that says, I want to give something significant to my kids, but I want to retain as much control over those investments, assets as possible, and I want to depress the value of that gift as much as possible. So they say, okay, let's do this in the form of a partnership. You put $1 million in, you're gonna have 100% interest, but we're gonna make part of this preferred. And the way we're gonna do that is you name the bell and whistle, and we're gonna put it around the preferred interest. So if you think you're gonna keep 10% of this entity, let's give that 10% puts, rights, calls, redemption rights, control, liquidation rights, everything we can think of to increase the value of that 10% and decrease the value of the remaining 90% and give you along the way as much control as we can over those investments that you plan to give away. And our client says, this is great. Okay, I'm gonna take all those rights, retain 10%, give away my 90%. Let's get an appraisal of that 90%. Now, is it 90% of the underlying assets? No, because of all the control that was retained in that 10%. That 90% might be worth 70%, 50%, 40%. We've moved all the value to our 10% because of all the bells and whistles we put around that ownership interest. And that's shifting wealth by value manipulation, which the IRS hates. And so that's what gets us to Section 2701 in 1990. And 2701 attacks this kind of planning very cleverly by saying, we're going to use something called the subtraction method when we're valuing transfers of interest. And here's my very simple description of the subtraction method. If you have 10 donuts and you give some away, and at the end you have 2 donuts, then the gift that you made under the subtraction method is 8 donuts. Very, very easy. But the problem is that 2701 says, if the 2 donuts that you kept have preferred economic rights, like some of the things that I described, they're not worth 2 anymore, they're worth 0. And so when you use the subtraction method and you had 10 and you retained 2, but those 2 are valued at 0, what you gave away is 10. You made an unintentional gift. The reason this matters in the hedge fund context is, keep in mind, junior equity, senior equity. Now, what I just described is a gift where I'm retaining senior equity, preferred rights, preferred stock. And the reason I'm highlighting that is for those of us who are not in the hedge fund world every day, the temptation, because we think so much about carry, we hear so much about carry, the temptation is to say carry is senior equity, but it's not, it's junior equity. The senior equity is the people who get paid back first, which is the hedge fund investors. So they're getting their money back first, that's the senior equity. The carry is junior equity. So back to my example, if my 2 donuts that I retained are senior equity, now I have a gift tax problem. And so what that means in the hedge fund world is if I give away my carry, junior equity, and I don't give away my senior equity, my interest in the limited partnership, I could be considered to have made a gift unintentionally of the limited partnership investment, which is harder to discount and which candidly I probably don't want to give away from an estate planning perspective unless I have to. And so here's 2701. 2701 says, here's the exception to the rules. In order to get around this, our real concern is shifting wealth by value manipulation. So here's what we're going to do. If you give away equal interests, equal shares of your junior equity and your senior equity, then 2701, the valuation rules will not apply. So that's where the vertical slice comes from, is saying, the client who walks in, they just want to give away that carry. That's what they're going to talk about. That's where the explosive growth is. But we have to say, slow down. Let's talk about 2701 for a second. You should know about this vertical slice rule. And you should know that it means in order to give away that carry, we're also going to have to give away an interest in the capital account in most cases. To the average fund partner, that is an unwelcome piece of news because they're not interested in giving away a piece of the capital account or the underlying investment, the senior equity, whatever we want to call it. I have to. And so here's 2701. 2701 says, here's the exception to the rules. In order to get around this, our real concern is shifting wealth by value manipulation. So here's what we're going to do. If you give away equal interests, equal shares of your junior equity and your senior equity, then 2701, the valuation rules will not apply. So that's where the vertical slice comes from, is saying, the client who walks in, they just want to give away that carry. That's what they're going to talk about. That's where the explosive growth is. But we have to say, slow down. Let's talk about 2701 for a second. You should know about this vertical slice rule. And you should know that it means in order to give away that carry, we're also going to have to give away an interest in the capital account in most cases. So to the average fund partner, that is an unwelcome piece of news because they're not interested in giving away a piece of the capital account or the underlying investment, the senior equity, whatever we want to call it. But it's a necessary evil. And there are other ways to plan around 2701, but vertical slice is so popular that it has practically become the rule in this area of the estate planning world. So the vertical slice makes sense to a lot of people because it's relatively easy to understand, easier to understand than 2701 itself. It requires some coordination with the fund. So I'm working with a partner, he decides to make a transfer. We have to say, okay, here's your GP interest, your carry, here's your LP interest. We're going to do, for example, 50% of each. We make sure we document that properly with the fund. An easier way to do that is to say, how about if I take my 50% of my senior equity, my junior equity, and I put it into a limited liability company. So now I'm dealing with the fund one time only, but if I want to transfer 50%, that's happening at the LLC level, and I don't have to interact with the fund to make that transfer. So that's a very attractive option to a lot of our clients because it helps to simplify things. It also means that they have control over distribution. So as carry is coming out of the fund, they have control over when those distributions are going to an underlying trust for family members. And it also means because we're putting a carry interest and an interest in a capital account into another entity, a limited liability company, there's an opportunity to layer in another discount here. So one thing to keep in mind, Laura Beck early this morning talked about the Powell case and the risk of inclusion of LLCs under 2036. And so that's something I'm just going to mention parenthetically. If you do use an LLC with your hedge fund or private equity partner, you have to make sure that Powell risk is on their radar. A tool as planners we should all have in our toolkit is Revenue Ruling 98.21. It's really a note of caution. And what that revenue ruling said is that when you make a gift of unvested stock options, the gift is not complete until the options vest. So if you make a gift of stock options that are unvested in 2017, the options don't vest until 2020, the gift is not complete until 2020. And the reason we care about that is because that's the valuation event for gift tax purposes in 2020. So again, why do we care about that in the hedge fund private equity world? The concern is that some of these carried interests, the general partners that hold them, are structured with a vesting time frame layered into the structure. And so the concern would be that we give away a carried interest that has not yet vested when the value is presumably very low. A lot of hedge fund partners will tell you at the outset the value is practically zero. It's not zero, but it might be closer to zero.
The concern is we give it away, but it's unvested, the gift is not complete, the interest vests a year or two later when now the carry has had a chance to appreciate and the gift is much larger than had been anticipated. There are arguments that this revenue ruling should not apply in the hedge fund context, since a stock option is a kind of derivative, whereas a carried interest is a property right. There are decent arguments that we should not have to worry about the vesting rules in the hedge fund context. But that being said, the safe harbor in the common practice is to avoid transfers of unvested interest and carries. So you're talking to your client, he says, okay, I get it. I understand vertical slice. I am going to use or not going to use an LLC. I have no vesting concerns in my fund, so I'm ready to make a gift. And what are the techniques that we see? And these are refreshers for many of you. The Grantor Retained Annuity Trust. With the Grantor Retained Annuity Trust, the idea is that you're going to give away, say, $1 million. You're going to get back everything that you put in. So if the Grantor Retained Annuity Trust has a 4-year term, in year one, I'm going to get back $250,000 plus the assumed IRS interest rate for December, which is 2.6%. Same thing the following year, same thing the following year. Year four, I get another $250,000 plus 2.6%. To the extent the value of the GRAT assets have exceeded that 2.6% assumed growth rate during the term of the GRAT, any excess gets to go to my family estate tax free. And so the reason estate planners love this technique, there's a couple of different reasons. One, it doesn't use any exemption from the gift tax. So for people who have maxed out on their exemption, a GRAT is a great option. This is a technique that is blessed by the Internal Revenue Service, so as long as you administer the GRAT correctly, the service is not going to audit the validity of the technique. And then another thing people like us like is that if the IRS for some reason does revisit the value of, say, a carried interest, a vertical slice that was put into a GRAT, and they adjust the value for some reason to increase the value of the gift, the annuity increases, and so the amount coming back to the grantor increases, so the gift will not increase. So therefore, the likelihood of an IRS audit seems relatively remote because the likelihood of them collecting tax dollars is practically zero. So this is a good match based on my description earlier of how a hedge fund operates and the liquidity with a hedge fund interest. You can hear this is a good match, hedge fund. And by the way, we see that in practice. I would say some of the most successful techniques that I've seen in the last couple of years, literally moving hundreds of millions of dollars downstream for families involved using hedge fund interests and GRATs. Another option for the hedge fund client, and this is very similar to a GRAT, is a CLAT, which is a charitable lead annuity trust. And the difference, quite simply, between a GRAT and a CLAT is that the annuity payments, instead of coming back to the person who set up the trust, are going to go to charity. So you're talking to your hedge fund client, they say, you know, I've always wanted to set up a family foundation. I've always wanted to fund a position at my favorite school. How can I do it using my carry as the primary vehicle? And we say, well, you know, we could do a GRAT or we could do a CLAT. If you do a CLAT, again, $1 million goes in. Year one, if it's a 4-year term, $250,000 goes to the charity plus 2.6% growth, et cetera, et cetera, et cetera, just like the GRAT. To the extent there's any excess in year 4 after the final annuity payment has been made, whatever is left goes to the benefit of your family. So it's a way to benefit the charity and get additional funds to your family. And so it's a great way for the family that wants to get a foundation up and running, add to the foundation, fund the position at the school. It's a great way to do those things. And not surprisingly, I can tell you my wife is a professional fundraiser. Charities love this, right? They're going to get, if it's $1 million CLAT, the great likelihood is that they're going to get $1 million of assets. It's something that they can start to book on their records. And for the donor, they like that they're going to get a charitable income tax deduction. It's a present interest in property that's going to pass, and so I get an income tax deduction right away. So this is another good one. Again, this requires some liquidity, so it's good for the hedge fund owner. But what of the private equity owner who says, you know, I might not have liquidity in this thing for another couple of years, and it could even be 5 or 6 years. So for that private equity owner, we're going to end up talking more likely, and by the way, I should say I've seen private equity owners who have done GRATs, but many of them find this technique more appealing. This is an installment sale to a defective grantor trust. And so you have a private equity owner who says, you know, I want to get rid of this $1 million interest. Again, liquidity is a concern, so how can I get this to my family as efficiently as possible? And what we say to that client is we're going to set up one of those intentionally defective grantor trusts that Meg DeLuca talked about earlier. So we're going to set it up, and it's going to use your social security number as its tax ID number. And if you want to sell $1 million interest, we're going to have you make a gift of $100,000 to that trust. And then once that gift is complete, we're going to let a little bit of time go by, and then we're going to sell your $1 million interest to the trust in exchange for a promissory note. The promissory note ordinarily is going to have a 9-year term, which means it's going to use the midterm rate that Dave talked about a couple of minutes ago, which is 2.11%, 2.11% for December of 2017, and it's structured as a balloon note. So the only obligation from the trust to the private equity partner for the next 9 years is to pay interest on that note. At the end of 9 years, we're hoping that the interest in the fund that was sold to the trust is going to vastly outperform 2.11%, and so that the trust is in a position to pay off that note. If it's not, we can refinance and hopefully extend the term of the transaction. So things that people like about installment loans: nothing has to get reported on a gift tax return. You heard the difference in the interest rate. With the loan, it's going to be 2.11% currently. With a GRAT, it's 2.6% in December. The things that are not as favorable: this is not a technique that's blessed by the code. In fact, this is a technique that the IRS is hostile to, and that hostility gets expressed in a number of different ways. But the most common are, they are looking, when somebody passes away in a large estate, and particularly if the IRS knows that there was a closely held business somewhere along the way, they are looking for notes to trusts for installment sales that they can poke at. And because with an installment sale, nothing is reported on a gift tax return, there's no statute of limitations running on any valuations that were used. So the IRS can go back, conceivably with a 20 or 30-year-old sale, go back and look at the appraisal and determine that there was a gift and that gift taxes should have been paid with interest and penalties. The other thing the IRS has done to look for installment sales is there's a question now on Form 706, which is the federal state tax return, where families are asked to report if they have engaged in a transaction whereby there was a sale to a trust created by the decedent. And so that is really nothing more than an attempt to uncover installment sales. All that being said, historically, this has been a great technique for families. If you said to me 10 years ago, the wealthiest families that you've seen or worked with, how are they getting money off the table? A lot of them have been using installment sales. And with some of the very wealthiest families that I've seen, it is dozens of installment sales over time, where the family is not only we're getting businesses downstream, but now we're using those business interests to participate in family investments. And so real growth is happening downstream from our clients. So those are the GRAT, the CLAT, the installment sale. Those are things that some of you have heard about before. This one is newer. It's not brand new, but this is the one if you're at a Cummings and Lockwood style Christmas party with a bunch of tax nerds and you want to show off, you can say, hey, how about those derivative contracts everybody's talking about? A derivative is just a security where the price is dependent on an underlying asset. So a put is a derivative, a call, a futures contract. And so I'm talking to my hedge fund or my private equity client, and they say, I get it. Okay, I hear 2701. I hear about the need to use a vertical slice, but I don't want to use a vertical slice. My capital account is a big number, and if I really just want to give away 25% of my carry, but if that means I have to give away 25% of my capital account, now we're talking about a meaningful gift. And even with discounts around that capital account, I don't know if I can stomach that big of a gift. And so what David Handler at Kirkland & Ellis came up with is, why don't we create a derivative that mirrors the performance of the carry? And so what we're going to do is say to our client, okay, I get it. You want to give away a portion of your carry, so let's create this derivative, and it's going to mirror the performance of the carry over the next 7 years. And so we create it, and we hire a well-respected appraisal company to come take a look at it, and they assign a value to the current right to an interest in the carry 7 years from now, or a derivative that performs like the carry 7 years from now. And that appraisal is going to take into account interest rates, the term of the derivative, and any hurdle rates that are built into the derivative. So there are some variables to that, but now that I know that value, my client says, okay, now I put cash needed to buy that derivative into the trust. The trust buys the derivative from me, and now I have an obligation 7 years from now to pay out whatever the performance of the carry was. So this is a pretty elegant way to get around 2701. I don't have that 2701 issue because I'm not putting in my carry. I'm not putting in my actual underlying limited partnership interest, I'm putting in a derivative that performs the same as my carry. So I don't have that 2701 valuation issue, so I'm sidestepping it and I'm getting that explosive growth outside my taxable estate while unhinging that carried interest from the underlying capital investment or the senior equity. The one note of caution here is the 2703 risk, and the valuation risk under 2703 is if you have an arrangement to buy an asset for terms that do not match fair market value terms, the IRS will ignore that sale for valuation purposes. And so that's why if you're going to go down this road, and this is going to be for a big transaction, you're going to focus a lot on the value of that appraisal to make sure that you have something that's indicative of fair market value. That is as much as I can tell you about planning for hedge fund and private equity partners in our 30 minutes together. Thank you.